Hi, I'm Richard Ehrlich. I'm here with my good friend Nick Fortune, affectionately known as The Bull. Welcome to another episode of Rich and the Bull, where our focus is to help you think like the rich and sort out the bull so you can make smart and sound financial decisions. Today's topic, and it's an important one like all of them are, is how to avoid a nasty April tax surprise. Nick, you know, you're one of the leading tax strategists around the country. Please share with our awesome audience a little bit some of the things that they can do to help avoid that nasty surprise coming up.
Yeah, well, obviously, being as we are right on the cusp of April, they are running out of time. In fact, if you waited until now for last year, there's not a whole lot you can do, but there's some things you can do. But here's what I can tell you is that the problem, as we talked on a previous episode, is the majority of tax planners really don't get the new Trump tax plan. So I don't care if you're Republican or Democrat or red state, blue state, whatever. It doesn't matter if you like this guy, didn't want him in. Regardless, you're going to have to deal. This is the way that it's moving forward, at least for the next, 4 or 5 years. So what I want to tell you is your planner, you need to make sure you tell them, file me an extension. Buy yourself some time to work through the weeds and to really get a handle on what your picture is and make sure that you're not doing things like we're going to talk about here that are going to cause a red flag.
Well, let me ask you, why aren't there our listeners local tax planners? Why aren't they doing something about this? I mean, shouldn't they be helping them avoid this tax surprise?
Yeah, one of the things that we run into is the fact that it's not a CPA that's the problem, it's a bad CPA that's the problem. We always talk about that. And a lot of them, unfortunately, they do the bare minimum. They keep on up on their continuing education, but they don't learn things proactively to help out their clients. And a lot of them, because it was more elective to learn about this rule, I mean, you had to do it on your own accord. They were busy being busy instead of spending their time in classes being proactive to really learn about this, knowing about what was going to come down the road. And so while they were getting busy here this last year, doing extensions and then doing the actual filings, they got so caught up that they didn't spend the time on the next year's education that they needed, and didn't, quite frankly, put you guys in a position where you would be proactive and you could be doing all the things that you needed to do so that you could keep more of your money this year, which don't do again, right?
Right. You know, I'll tell you, if you're thinking to yourself, this is so confusing, I just want to throw my hands up in the air, you're not alone. Because taxes are confusing, and probably they're confusing by design. I mean, Nick, tell me, this sounds like it's a constant changing evolution. It's not like you get this and then you're set, right? It's constantly changing.
We're going to talk about a half a dozen things that people can really pay attention to watch out for themselves. And regardless, I would just warn you that even if your CPA wants to take them, don't. Because remember, it's not going to be your CPA that is going to be standing before the man when you face an audit, right?
Right, exactly.
It's going to be you. So remember, you're in charge of your money, your finances, your family, okay? You are the boss. You tell your CPA what to do. Your CPA shouldn't be telling you what to do, and you do that through education. So one thing is, I will tell you that is a hot hit red flag. Do not, no matter what, take a room in your house as a deduction. There's hundreds of other deductions that are available to you. Stop taking your house as an office deduction. Also, you need to be able to tell a story through documentation. So another important thing, you need to keep up on your documentation.
Well, give me an example. What do you mean, like, by keeping documentation?
Yeah, so your receipts. Why did you do something?
Okay.
You could have a scenario completely different this year than last year, right?
Right.
There could be a real income discrepancy. So maybe last year you made $100,000 and these were the deductions you took. But this year you were successful and you made $150,000 and you have a lot more deductions. The IRS wants to see you explain it. You have these extra documents that you can file with your returns. I would behoove you to go out there and have your CPA go out there and write a letter of explanation. Why has the amount of money that you're contributing, why has the amount of money that you're deducting increased because your income has increased.
So it's sort of like there's a story that they don't have to think through this,
Yes.
and it's logical, right? You know, some of the clients that you've done some amazing work for a lot of my clients around the country, and you talk about creating non-taxable events, and tell me how that interacts with this whole avoiding the April tax surprise.
Yeah, so, you know, the idea is to be out in front of this thing and be proactive. Obviously, it makes a whole lot easier to file your tax return when you take a giant chunk of your monies and you're able to create a non-taxable event. Unfortunately, the tax code is really not built for W-2 employees out there. I mean, it's really built for entrepreneurs and investors. And if you are a W-2 employee, one of the best things that you can do is set up a business. I mean, there's all these multi-level marketing companies where you can sell a lotion, a potion, a pill, something like that, right? And I've never been a big believer in that, but that's just me. I'm too busy with my time. I don't have that. But let's just say you're married, your husband makes X amount of dollars, he's a W-2 employee. There's not a whole lot you can do about that. They're going to take the money off the top, and you don't have a lot of deductions coming to you. But if you're the spouse, maybe you live at home, maybe you both are W-2 employees, and you go set up a business and you make yourselves a part of that, or if you're single and you are a W-2, there's nothing that says that you can't set up your own business.
Right.
And then the things that were not deductible as a W-2 employee,
right,
you now can run through your business. And that changes a lot of what you get to put in your pocket.
You know, these are some excellent points. You know, I don't know if this has impacted anybody of you, if this sounds familiar, right? You know, January and February come, and even in March right now, and you start gathering all your tax documents. Well, what year are we in? We're in 2019. What are the tax documents you're preparing for? It's 2018. So we talk about, Nick, about helping clients being proactive.
This is a carousel, Rich. This is what we see. So what happens is somebody last year didn't get going, right? So they finish out the end of the year. They start giving their documents to their tax preparer in February, right? They sit down with them. They meet in March. They get a surprise of their life. They got to go into April, right? And then they got to pay this tax bill. But now they're 4 months into the next year.
So it's
right?
kind of, it perpetuates itself.
Yeah, and then they say, oh, well, the heck with it. I'm already 4 months in. I'm just going to continue what I'm doing. And it's this vicious cycle, this carousel that they don't ever get off of. And they just keep giving money that they don't have to Uncle Sam undeservingly because they don't do any kind of planning. And so it's like, you got to stop, right? You're always busy being busy. People will always find something that they want to do.
Right.
They don't always find time for things that they need to do. But when it comes to that extra vacation you get to go on, or that vehicle you now get to drive, or the money you get to put in your retirement, a better school that your kid gets to go to, something that you get to experience.
It changes. It has a positive impact on your lifestyle.
You've got to go out there. You've worked for the money. You owe it to yourself to take the time to do this, so that you can put this hard-earned money away and keep it. Why go to work for Uncle Sam every day? Go work for yourself.
You know, that's why I really, really commend everybody here watching this episode and the previous episode, because you know what? You're sitting there saying there's got to be a better way. And why we created this channel is to be that coach, to kind of guide you through there, to sift through all the myths and misconceptions, to get the facts so that you can make smart financial decisions. And I think what I'm hearing from you, Nick, is that in order to avoid the April surprises, you got to be proactive. You have to have the right facts, and you got to do it before, so you can have a positive outcome.
One of the things that we've just seen in this last week is just with a few clients, saving them almost over $100,000 in deductions that they had coming to them, that the IRS said, these are deductions you have coming to you that they were going to pay. And then the shock of my life when somebody says, oh, I'm going to go take that back to your CPA. You mean the guy that's been sticking it to you for the last decade? He didn't do his job. They came to us. We found it for him, and now they want to go back to the guy. Listen, you need to get another perspective on your accounting. You need to get another perspective on your tax planning. And we're going to do that for you for free, but you've got to reach out for you. We want to look at your plan. We will find money that you are unnecessarily giving to Uncle Sam. We will find structures and strategies where you can put more money in your pocket and less in Uncle Sam's, but you got to reach out. You got to be proactive. We can do that.
So, just on that note, and the idea here of this channel is about you guys, right? So I often see this, not just in the planning that you're talking about, from taxes. I have people that have money that's in the stock market. They're in investments, and they're paying literally tens of thousands of dollars on money that they haven't even received. So this is about you guys. If you have questions, comments, let us know. That's what this program's about. You have you have really financial coaches here to kind of guide you through tax strategies, asset protection strategies, all these different things that are here for you.
A tax is a tax is a tax.
Right.
They come in different forms, and they cost you money. Working around the laws and the rules. We're not talking about working in the gray area here.
Right.
Or working in the black area. I'm talking about taking advantage of the code of things that you all have coming to you.
They're entitled to it.
They're entitled to it. In fact, the IRS on their website, they say it's the obligation for every American to pay the least amount of a tax that they can. This is the Treasury saying to you, it is your obligation to take the least amount of tax that you possibly can. But that means that you have to do something about it. Nobody's going to do it for you. There is no magic pill. Nobody's going to step up. You've got to take control of your legacy. You've got to take control of your planning, and you need to act and be proactive.
These were amazing points, and I always tell people, now you know about this. Don't keep us a secret, right? I mean, these are things.
No home office, guys. Make sure you explain what it is. Draw a picture. That person on the other side, he's just like you. He wants to know how you got there, right? If you can't document it, don't put it, but make sure you do keep documentation and tell that story. Don't go out there and do crazy stuff. Don't understate income. Don't overinflate deductions. I know that you think that you're getting away with it, and you will up until the point where you get audited. Don't do some of these things that are cause a red flag. Create non-taxable events. Learn how to structure and strategize to do the things now. Create an entity if you're a W-2 employee. If you have an existing entity, make sure that it's tailor-made to fit exactly the way that you do business. Make sure that you list the deductions and things that are expenses in the business.
Key points.
We will look at all that stuff for you, but these are very important points that if you just stay with some of these core things, and we can make this so big or we can make it so small, but the bottom line is get another pair of eyes looking at what you're doing and make sure that, like I say all the time, don't be the one without a chair when the music stops, because it will be the surprise of your life.
Guys, as we wrap up here, in a future episode that we're going to be talking about, if people ask, hey, if I have a stock or an investment, should I own it in my IRA or outside of my IRA? We're going to talk about that, and there are monster differences. Don't keep us a secret. Thank you so much once again for tuning into another episode of Rich and the Bull. And really, congratulations for taking your financial future of your own lives into your own hands.
Please remember to not keep us a secret. Like and follow us on Facebook. Subscribe to our new YouTube channel. Like, share, and comment on our videos. We want to hear from you. What do you like? What don't you like? Are there any topics that you would like to hear from us about? We'd love to hear from you. And those that do comment will enter yourselves in for a $25 raffle Amazon gift card. Stay tuned for our next episodes, and remember, take the financial bull by the horns and don't mess with the bull. Thank you, guys. We'll see you all soon in the next episode.